The good news is I think we've seen peak inflation, and I think we've also seen most of the heavy lifting that central banks are going to need to do, at least the Fed, the ECB, and the Bank of England, they've already done. So I think they've gotten rates into restrictive territory. But I think inflation this year is proving to be more sticky and stubborn than they hoped or expected. In terms of what I think each of the major, those three central banks will need and will hike some more. Importantly, the Fed recognizes that they will be inclined to cut rates before inflation gets to 2%. The rationale simply being that if inflation does fall into the 2s, then keeping rates at elevated levels is actually tightening policy further, and so they may want to downshift rates once they start to get good traction on inflation. And so I have done a little thinking about the issue of, will a future Fed in a routine recession, unemployment rate rises by a couple of points and GDP growth is negative for 3 quarters, will a future Fed say, you know, the Powell Fed back in 2020 backstopped the corporate bond market and backstopped the municipal bond market, and it actually started a program for Main Street lending. You know, we should do that too. You know, I think that would be a mistake. I am certainly in agreement with a lot of folks who recommend a higher inflation target, that in the abstract or with a clean sheet of paper, would it make a lot of sense to do so? And the answer is yes. You know, can the economy function with an inflation rate of 3 about as well as 2? I think so. But for a variety of reasons, you know, global central banks in advanced economies have coalesced around aiming for a 2% target. And I think it would be institutionally costly to the Fed's reputation to change the target after a prolonged period when it missed the old target. And I think conveying success in terms of a range centered on 2% and not a number is something that the Fed might consider. But I don't see them endorsing a higher target. So I think in some ways the discussion's a little bit confused because it focuses on whether it be a recession or not a recession. I think a technical recession will be hard to avoid, given that the Fed itself thinks that there will need to be some softening in the labor market in order to bring wage inflation down. But still, the scenario I laid out to me would look like a pretty soft or softish landing. So I think that the magnitude of those effects on inflation are hard to quantify, but certainly the direction of travel is the remapping of global supply chains, onshoring, friendshoring, the green transition are all going to be factors that are going to be putting upward pressures on cost and potentially upward pressures on inflation. It's not clear what direction it's going to have, for example, on interest rates. There are those who argue that large language models are going to be very, very disinflationary in that they are going to lower the cost of a lot of service and human capital intensive activity. On the other hand, there are other folks, and sometimes the same folks, who argue that large language models are going to rapidly boost productivity growth. So, you know, more rapid growth will tend to push up bond yields. More significant disinflation will tend to push down yields. And so